a model for overconfidence. Uh, we are going to say that there is an expert, the one in the middle here, the box over here, and his task is to forecast. So pretty much he forecasts an event to occur, he forecasts the price of a stock or price of a commodity to go somewhere. So basically he forecasts. And he receives a noisy signal. The noisy signal says pretty much that one of two equally likely events will occur, and there's a probability P for that, which lies between 0.5 to 1. Okay, if he says 0.5, then he is pretty much the same as you and me, and there is nothing different in his, there is no competency that he has. So we name this P as the expert's competency. Okay, so now we have the noisy signal going to the expert. The expert takes this noisy signal, tries to find out something useful out of it, and gives a forecast. So he announces that his forecast is correct with probability Q, which again is between 0.5 to 1. Okay. The way the model works is that we assume that there is no benefit in announcing Q greater than 0.5. But if he's wrong, the expert takes a hit. Pretty much it's a cost for him that he takes a hit. This cost is a function of Q and minus 0.5. Okay, good. So now we define the payoff of the expert. So his job is to give forecast, how much does he get paid in the end, or what's the payoff that he gets received in the end. So the forecast goes to the market sees the forecast, sees the dude who is giving the forecast, and says, okay, we expect this dude to be so much competent, right? And that's what I've said over here as M. X is just a scalar constant function that we have just put in over here, and it scales M. So we have M over here, which is the market expectation of expert's competency, minus 1 minus P. P, as we described last time, is the expert's competency. So M is the market expectation of this competency. Q is the probability by which he announces that that what is forecast, how confident in his forecast. Okay. So it's I mean, looking at the formula, we can clearly say that if Q is equal to 0.5, then C is equal to 0. So expert's payoff is just the market, what market believes his expert's comment is, or competency is. So over here we make graph in which on the x-axis we have P, which is the expert's competency, and Q, which is the market expectation of the expert's competency. So we are saying that, okay, so both of them starts at 0.5 because that's what the probability values, we defined. So at 0.5, we are saying that a point comes where if the expert's competency is above P dash or P star in this case, or as soon as it reaches P star, market expectation for that competency becomes 1. Okay, so market doesn't care. As soon as it goes beyond P star, the market expectancy for the expert's competency is 1.